Multifamily and retail defaults are driving CMBS delinquencies, climbing 29 basis points in May to 2.07%. The multifamily delinquency rate now at 4.55%, the highest of all property types. Retail now at 2.24%. No big surprise in these numbers, as we saw two major defaults just last week. Dana Point, California's five-star St. Regis Monarch Beach Hotel will go on the block in July, as the owners are in default on a $70 million loan from Citigroup Global Markets Realty Group. This is a swanky golf resort where insurance giant AIG held a $500,000 corporate retreat just weeks after accepting an $85 billion federal bailout. Now, trouble in the hotel sector also hit the W in San Diego. Sunstone hotel investors say they will hand the property back over to its lenders after defaulting on its loan. Sunstone, which has a stake in 43 mostly upper crusty hotels, say its revenue per room across its properties is down nearly 25% in May. So what's the play here? Well, also last week, Richard Ellis Group announced that hedge fund billionaire John Paulson would buy $100 million in stock. If you go by the theory that only the strong survive, well, then Richard Ellis at about $10 a share is not a bad buy.
Do we have a real potential shoe to drop here?
You know, Aaron, you hit it right on the head. The issue is the financing. And the question really begs from going to very liberal underwriting and, let's say, high relationship between the debt and the value of the assets to now where the pendulum has swung the other way, where all of the lending institutions are being very, very conservative in their underwriting. So it's making debt difficult across all classes of assets. And so once that pendulum starts to move back in the other direction, and let's say there should be good underwriting, but somewhat in the middle, I think you're going to see the real estate industry in general just bust loose in terms of commercial assets.
Jay, what about your view? And I don't know if you saw the headline below, but we do have the formal filing now of Extended Stay America, which was sort of a extended stay hotel chain, right? Filing for Chapter 11.
Right.
Do we have a big next shoe to drop, or are there certain areas where we're going to see a lot more headlines like that and other areas where we could see real growth?
I think, Aaron, first of all, good morning. I think that we're in a market now where we're going to see several little shoes drop in various sectors as primarily private borrowers face large near-term maturities. On the flip side of that, we're really trying to take advantage of that in the public arena. Public REITs have raised approximately $18 billion since November. They've strengthened their balance sheets, and they're positioning themselves not only to survive this downturn, but also to take advantage of it. We see tremendous opportunities right now in REIT preferreds.
Many of the investors I'm speaking to are saying, look, I want to get into the commercial real estate market. I want to borrow. I want to lend. I want to buy. I want to sell. I want to reposition my portfolio. The whole question for us is really just around finding a loosening up of the debt here. Once that happens, I think, again, as I said earlier, I think the real estate industry in terms of commercial real estate is going to have a quick turnaround as it had a quick downturn.
Jay, where specifically is going to be the quickest turnaround, do you think, of all the sectors in commercial?
Well, Matt, I think that right now we're positioning ourselves to take advantage of a turnaround near term in the more defensive sectors. So we see apartments, healthcare, and some of the specialty sectors that have been more recession resilient really rebounding first, and then eventually lodging, industrial, retail, and then finally office. So the more defensive sectors at the front end, and then the more economically sensitive sectors after that.